what's the advantages of becoming an opportunity zone business? You want to hit this, or I
go
play
ahead
with
and
this
hit
all
this.
day long? Right? This is crazy. So here's the deal with the opportunity zone, the Tax Cut and
Jobs Act.
Yeah, the TCJA. I'll just call it the Trump Tax Act. But so is it too late to issue a 1099 or not? Somebody just asked. It's not too late, but I probably wouldn't for 2018. You are late. You're going to pay a penalty, and it depends on who it is too. If it's a large amount, I would pay the penalty and just go ahead and do it. If it's a small amount, then I probably wouldn't. I would take my chances. What are the advantages of becoming an opportunity zone business? So here's how it works. The Tax Cut and Jobs Act created these areas where they need basically economically disadvantaged areas where they want people to invest in the businesses and in the properties there. And so all states came up with a list of the zip codes that were their areas, what they call opportunity zones. So disadvantaged areas that need investment. What it is good for the investor is that you can defer your capital gains, any capital gains, if you invest in what's called an opportunity zone fund. So it's a LLC taxed as a partnership, LLC taxed as a corporation, or a corporation. Those are your opportunity zone funds. As long as you invest those funds within 180 days of the taxable event, so you sell some Bitcoin or you sell stock or you sell property, and within 180 days of the sale, you put it in an opportunity zone fund, and that opportunity zone fund invests 90% of its assets in the opportunity zone. So if it has $1 million, it needs to buy 900,000 of opportunity zone property or businesses. The reason people do this is twofold. The number one reason is because you're deferring that gain. You do not eliminate that gain that you have. So let's say Jeff sells $1 million of Bitcoin. He owes, let's say it's long-term, he's held it for over a year. He owes long-term capital gains in 2019. He just sold it. He puts it into an opportunity zone fund that's buying Dairy Queens in opportunity zones. I'll just use that as an example instead of real estate. I know all you guys want to talk about real estate, but these can be businesses too. And Noman, this is going to make sense here in a second of how it's different than a 1031 exchange. So I put the money into this thing. My $1 million, or Jeff's $1 million, he doesn't pay tax on in 2019. He doesn't pay tax on it in 2020. He doesn't pay tax on it in 2021, 22, 23, 24, and then comes 2026. He will pay tax on that money in 2026, but he will also get what's called a step up in basis on a portion of it. And that portion of it is 15%. So if Jeff has that $1 million, he would owe tax on, when are the taxes due? April 15th of next year if he sold it this year. So he'd owe tax on $1 million. He'd owe 20% on $1 million plus the state, where we're in Nevada, so there's no state income tax. So he'd owe $200,000. What he gets to do is he gets to not only does he not have to pay that $200,000, but he gets a step down or step up. He's going to not have to pay tax on 15% of it. So he's going to pay tax on $850,000.
Mm-hmm.
And let's say it's still 20% and it's $850,000. He's going to pay $170,000, not the $200,000, in 2026. So that's benefit number one. Benefit number two is the investment. He put $1 million into an opportunity zone, and let's say that $1 million becomes worth $5 million. So long as Jeff holds that property for 10 years, so he has these Dairy Queens and he owns them for 10 years, he pays zero tax on that growth. So at the end of 10 years, Jeff sells all of his Dairy Queens and he gets to keep $5 million in his pocket. So Jeff paid, instead of $200,000 of tax, if he had done this without using the opportunity zone, he would have paid $170,000. Plus, if he had done his own money, he would have had to pay on all that gain, $4 million worth of gain. He would have paid another 800,000. He'd be paying close to it. He would have paid basically $1 million in taxes. Yeah. He instead is paying 170,000. So he lowered his tax bill by $830,000 into that scenario. And I just pulled that up out of my ear. How long can you park the money before reinvesting? Somebody asked about this. So when you put your money into a opportunity zone fund, there's a testing period every 6 months or the end of the year where the 90% needs to be invested in the opportunity zone. So you literally have to put that money in, I would say within 6 months. So I was talking about it with Clint today, one of my partners, and we're not aware of anything that accelerates that. But if Jeff sells his Bitcoin, puts it in a fund, and that fund deploys those resources 3 months later, technically Jeff could be 9 months after the sale date and still be in compliance. How do you find those opportunity zone funds? They're out there, or you make your own, Norman. So you can become your own opportunity zone fund by creating your own opportunity zone, LLC, taxed as a partnership or corp, and we have to do a special filing. I think it's an 8996 that we're filing, and you're deferring it with an 8949 on your 1040.
Right.
See, I love tax forms. I only know that because Jeff Smart, he knows the tax forms. What is required to move an existing business to an opportunity zone? I don't think you can take something that you already own and make it into an opportunity zone property unless somebody's investing in it that's not related to you. Is it possible to create an OZ fund for unrelated third party investors and not be a broker dealer? Yes, that would be called a Reg D offering or a private placement. And yeah, you don't have to be a broker dealer to do that. You can even get carried interest. You get all these good things in those, but that's security stuff. And then are there any self-dealing issues investing in opportunity zones, which I have an interest in, or does it have to be someone else's business? Technically, I think it has to be somebody else's business, but I'm just going to give you this. All I can tell you is from the tax standpoint, this is how the rules work. You always want to look. And yeah, somebody just said, hey, you'll get a recording of this. Somebody's asking. This is kind of complicated stuff, guys, right? And then somebody just asked a really good question, which is what's the difference between an opportunity zone and a 1031 exchange? So a 1031 exchange is for real estate only, and you have to exchange property for more real estate. And when I say property, real property, so real estate for more real estate.
Right.
So Jeff, let's say I sell my mobile home park. Can I buy a commercial building?
Yes.
I sell my condo. Can I buy 6 single family residences?
You can.
Yeah. What are the rules regarding a 1031 exchange?
1031 exchange, you have to identify your replacement properties within 45 days of selling your property.
Yep.
Everything has to go through a qualified intermediary. This is basically somebody who's going to hold the cash for you from the sale. The exchange of properties actually has to happen within 180 days, but it has to be one or more of those properties you initially identified in the first 45 days. So if you're going to do one of these things, you really need to have your ducks in a row before you start it.
Yep. Or you do a reverse exchange. If you already have property, get them to acquire the property for you and then sell your properties and exchange it. But it has to be of greater or equal value to avoid the tax. And then your basis just goes forward. So the reason the opportunity zone is so hot is because people are like, hey, I'll dump a bunch of money into real estate there. The rule on the real estate is you have to double the improved value, or if it's land, you just have to double the value. Meaning that if you buy a piece of land for $500,000, you have to invest $500,000 in improvements. If you buy a piece of property like a building for $1 million and the land is worth $200,000 and $800,000 is that building, you have to invest $800,000 in that building. And it just has to be like if you put cash in there, you can you have 31 months. So if you sell your Bitcoin for $1 million, you buy a piece of property for 600,000 and you have 400,000 sitting there in cash. If you put that $400,000 into that $600,000 property, assuming that, let's say the land value was 200 and the improvement was 400, then you're fine as long as you do all the rehab within that 31 months. If you can't do it, then a portion of it will be taxable back to the very beginning. It could actually be pretty nasty if you don't. So you got to make sure that you're picking, when it's real estate, that you're doing it right. God, I got a lot of questions on these. This is fun. This is always a kick in the pants, these questions. Okay, if I do a 1031 exchange, rental into a rental, and keep the new rental as a rental for 2 to 4 years and then move in and live there for 3 to 5 years, can I sell it and take the home exclusion? How is the accumulated past depreciation of a rental accounted for at this point? Alyssa, you ask really good questions. So first off, we have investment property that then we're going to make it into personal property. I think you have to hold it for 5 years. Investment property to make it a 121 exclusion.
Oh.
And then you have periods of disqualified use. So usually we're doing the opposite. You have a piece of property that you've lived in and owned, and then you rent it for a few years and then sell it. The rule is you have to live in it as your primary residence 2 of the last 5 years, and then they're going to disqualify a portion of it, of the total amount of time you owned it, for disqualified use, which is what that rental is going to be. Since it went rental and then became a personal residence, they're going to say, all right, you lived in it for 5 years, you rented it for 4 years, you're going to get 4/5, or whatever they call that. Yeah, that's about 4/5, whatever that ratio is, of the $500,000 exclusion if you're married, or if it's 250. And then here's the most important thing for you to take away from this, Alyssa. The 121 exclusion is only for capital gains. So it will have 0 effect on your depreciation. Your depreciation, you'll have to recapture all of it, but it goes up to 25%. So what I usually do when I see these types of scenarios is I say, if it was a rental before, make it a rental again and then sell it under a 1031 exchange, and then you can avoid the tax too. Somebody says, where do I find areas that are opportunity zones? Is there a website? Yes, you Google opportunity zones heat map and you will find it. It's one of the first things that pops up. Can an existing property be classified into an OZ if it is the designation? I don't know what that means. What is needed to do that? You just have to be Eva. You just have to be in the opportunity zone, which is in a zip code. And then somebody says, would the work for exercise? Would this work for exercising stock options? Yes. When I exercise them, they take taxes off the top and send me the balance. Would like to use the funds for an OZ investment. What about the taxes paid up front? You will get them back, Todd, because you're going to say I'm deferring all my tax, right?
I'm not sure about that because it's usually a payroll withholding on the stock grants.
Well, it depends on what you're doing with it. You're exercising a stock option, and then is he selling the stock? I guess it would have to be capital gains. So I believe you're going to work, Todd, but it would have to be capital gain.
Yeah, a lot of times with these stock options that you're exercising, that you've been granted options by your company, you're already getting a step up in basis in that stock, so there's probably not going to be a whole lot of capital gains there.
Mm-hmm. Somebody said, let's see. Somebody asked a really long. I thought it might be opportunity zone related, but there's lots of questions.
But yeah, I've noticed with these opportunity zones,
it's payroll withholding on capital gains. So as long as it's capital gains, Todd, then you'd be able to do it. Yeah, so let's say that if it's an apartment building in the OZ area, can you benefit from the capital gain treatment? Yes. And if you invested it for 10 years and it doubled, you would have paid 0 tax. You're hitting the nail on the head. That's what they want you to do. They want you to go, and there's people that are doing it. We have clients that are doing it. Maureen's a great example, dumping a lot of money in there because they know that these properties are worth a ton after a while, especially what some people do is they target apartment buildings with bad management or that have lots of money that needs to be put into them. So you have to put whatever that improved value is that's sitting on that land, you have to double it.
Yeah, so you got to be a little judicious about the property you're picking out. I like what you were saying, good ideas. Uh, the rundown, more historical type buildings or gold mines or something like this. Uh, there's just lots of opportunities here. And it's obvious that this credit was designed, or this deduction, to help these disadvantaged areas.
Yep. And if somebody just said, we had the property and we already turned it around, does it qualify? No, it won't qualify. But here's what you do. Now you know about it. You already know what you're doing. Target another building in that opportunity zone, pull the money out of the existing property to invest in it, and then sell a bunch of something with a bunch of capital gains. It's all just cash. You're just designating, hey, I'm deferring the cash or the capital gains that I had on investment X for putting it into this opportunity zone.
Right.
It doesn't matter where you get the money. So yeah, I'd pull the money out of the existing, and then I would defer. Like I'd say, hey, I have a big tax appetite. I'm going to sell a bunch of stuff that made money, and I'm not going to pay tax on it. And I'm going to put it into another building in the opportunity zone. So I hope that makes sense.